0.78%. That's the number Fannie Mae reported for multifamily delinquencies in March 2026, everyone. It's a hair below the 0.8% peak from the 2008 housing crash. Fannie Mae's own official filing says the spike came from, and I'm quoting directly, weakened property valuations on properties where foreclosure was probable. Let that sink in. Fannie Mae is telling you in their own words that foreclosure is probable on their apartment loans. This is the final warning. Highest reading since 2008. Stick with us because there are three things about this the mainstream headlines are missing. Number one, we're going to show you the specific mechanism nobody's explaining. The $875 billion refinancing wall that's about to hit. Number two, we're going to show you why this is the 2007 credit crisis playbook repeating in real time, not 2008 yet. And number three, we're going to show you the exact cities where this apartment distress is already killing single-family home prices right now. Now, let me show you exactly what Fannie Mae is reporting so you understand why this is a big deal. In their first quarter 2026 multifamily earnings, Fannie Mae disclosed that their provision for multifamily credit losses jumped to $174 million. Compare that to just $5 million in the previous quarter. That's a 35 times increase in one quarter. That's not a rounding error. That's an institution bracing for real losses. Chief Financial Officer Krissa Halley told investors on the Q1 webcast that Fannie is, quote, closely monitoring factors that could influence the credit performance of our guarantee book. Translation? They know more pain is coming. And it's not just Fannie. Freddie Mac's multifamily delinquency rate hit 0.48% in late 2025, the highest in decades and above their previous peak of 0.39%. The Mortgage Bankers Association confirmed all of this in their June 2, 2026 delinquency report. Reggie Booker at the MBA said increases in commercial mortgage-backed securities and Fannie Mae delinquencies point to, quote, continued pressure from higher borrowing costs, refinancing challenges, and weaker conditions. Everyone, when Fannie, Freddie, and the MBA are all flashing the same warning light at the same time, you pay attention. And here's why this is happening. The mechanism is actually simple once you understand it. Landlords and apartment developers who borrowed cheap money during the pandemic, construction loans and bridge loans at 2 or 3% interest, those loans are now maturing. And they have to refinance into a market where rates are sitting around 6 to 7%. Do the math with us for a second. If your building was underwritten at a 3% debt payment and you're now refinancing at 6%, your debt service just doubled. Meanwhile, in a lot of these markets, the rents you're collecting have actually gone down. So you got double the debt payment and lower revenue at the exact same time. That's how you get foreclosures. And this isn't a hypothetical. According to the Mortgage Bankers Association's February 2026 CREF forecast, $875 billion in commercial mortgages mature in 2026 alone, and another $652 billion matures in 2027. That's over $1.5 trillion in commercial real estate debt that has to be refinanced in the next 18 months. So let me resolve the first thing I promised you at the top of this video. The specific mechanism nobody is explaining. Here's the deep data. That $875 billion maturity wall is not evenly distributed. According to the MBA's own breakdown, $396 billion is sitting on the balance sheets of commercial banks. Another $200 billion is in CMBS bonds. That's the Wall Street securitization market. And $163 billion is in what's called credit companies and warehouse lenders. Those are the private lenders who did all the aggressive bridge lending during the pandemic. And here's the kicker. The credit company debt has the steepest concentration at 29% of their book maturing in a single year. Now, the government-sponsored enterprises, Fannie, Freddie, FHA, only have about $39 billion maturing in 2026, which is only 4% of the total wall. So the immediate maturity risk is not directly on the taxpayer's back. But here's what nobody's telling you. The GSE combined multifamily book totals over $1.03 trillion. Fannie has $538 billion and Freddie has $496 billion as of the end of 2025. Even though their maturities are staggered, they are the guarantors on all those loans. When these apartments default, Fannie and Freddie eat the losses. And Fannie has been in federal conservatorship since September 2008, which means eventually the taxpayer is on the hook. Real quick, if this market intel is helping you make better decisions, hit that notification bell. We drop new housing data every week, and the viewers who catch it first get the best opportunities. The bell ensures you see everything immediately, not days later when the market's already moved. All right, so let me show you where this is showing up in the real economy right now. The commercial mortgage-backed securities delinquency rate, CMBS, hit 7.28% in the first quarter of 2026, according to the MBA. That's nearly 6 times higher than the delinquency rate at commercial banks. 6 times higher, everyone. The July 2026 Intercontinental Exchange Mortgage Technology Mortgage Monitor confirmed that all 30 metros posting year-over-year single-family home price declines are localized in the south and west of the United States. Head of Mortgage and Housing Market Research, Andy Walden's data shows that nationally, home prices are actually still positive at 1.3% year-over-year, but the pain is concentrated in specific metros. And when you look at the S&P Cotality, formerly CoreLogic Case-Shiller data for April 2026, the metros getting hit hardest are the exact same ones with the worst apartment overbuild. Tampa down 1.8%, Phoenix down 1.7%, Dallas down 1.6%. And here's the biggest one. The Federal Housing Finance Agency reported that Austin, Texas home prices are down 6.9% year over year in the first quarter of 2026. That is the single worst performing major metro in America. And here's the really alarming part. Lawrence Yun, chief economist at the National Association of Realtors, said on July 9, 2026, that existing home sales have been stuck between 3.9 and 4.2 million for 36 of the past 38 months. Yun's exact words, the only other time that happened, foreclosures were flooding the market. And that brings us to the second thing I promised you. Why this is the 2007 credit crisis playbook repeating, not 2008 yet. And here's where it gets worse. Let me walk you through the 2008 timeline because this is critical. April 2nd, 2007, New Century Financial, one of the biggest subprime lenders in America, files for Chapter 11 bankruptcy. June 7th, 2007, Bear Stearns halts redemptions on 2 of its mortgage-backed hedge funds. August 9th, 2007, BNP Paribas freezes 3 of its investment funds, and everyone was told at the time this was contained. Nothing to worry about. Then March 16th, 2008, Bear Stearns sold to JP Morgan for pennies on the dollar. September 6th, 2008, Fannie Mae and Freddie Mac put into federal conservatorship. September 15th, 2008, Lehman Brothers collapses. Now, here's our controversial take, and we'll say this straight because the data supports it. The credit market stress in 2007 preceded the residential home price collapse by 12 to 18 months. What we're seeing right now with Fannie and Freddie, multifamily delinquencies at their highest level since 2008, with $875 billion of maturities coming due, with CMBS delinquencies at 7.28%. This is the same early warning signature we saw in 2007. And according to Urban Institute data from the last crash, multifamily property values fell approximately 40% peak to trough during the Great Financial Crisis. That is sharper than the 32% decline in single-family homes. We're not saying 2008 is happening next Tuesday. What we're saying is credit markets always crack before home prices crack. And the credit markets are cracking right now. Which brings me to the third thing I promised you. The exact cities where this is already killing single-family home prices right now. Let me show you what's happening on the ground. In Austin, Texas, apartment vacancy is 13.7% according to CoStar. Rents are down 4.8% year over year per Yardi Matrix. And single-family home prices are down 6.9% according to FHFA. In San Antonio, Texas, apartment vacancy is 15.8% per CoStar, the highest of any major market in America. In Phoenix, Arizona, vacancy is 11.7%. And Case-Shiller home prices are down 1.7%. In Denver, Colorado, rents are down 3.1% per Yardi Matrix. Home prices are down 1.8% per Case-Shiller, and Colorado foreclosure filings are up 57% year over year, according to Adam Data Solutions. In Tampa, Florida, home prices have declined for 13 straight months. In Cape Coral, Florida, apartment vacancy is 11.3%. And here's the math that ties this all together. The National Association of Realtors reported the median existing home price hit a record $440,600 in June 2026. At today's mortgage rates around 6.5% with 20% down, that's a monthly payment of roughly $2,778, including taxes and insurance. To afford that under the standard 28% front-end ratio, you need household income of approximately $119,000 per year. The U.S. Census Bureau reports the actual median household income is $83,730. That's a gap of over $35,000, 42% above what the typical American household earns. That is why demand is collapsing in the exact metros that overbuilt. There just aren't enough people who can afford these rents or these homes. So let me address you directly based on your situation. If you're a seller in Austin, Nashville, Tampa, Phoenix, Denver, San Antonio, or any of these Sunbelt metros I just showed you, price aggressively now. Every month you wait in these markets, the data gets worse. Sellers in Austin have already lost 6.9% in a single year, according to FHFA. Waiting has cost real money. If you're a buyer in these markets, be patient and be smart. Understand the specific data in your zip code before you make a move. The decisions you make in the next 12 months could save you or cost you tens of thousands of dollars. Watch the debt service coverage numbers on new apartment financing in your market. Watch the concessions being offered. Those are your leading indicators. If you're a homeowner or an investor with equity exposure to any of these markets, this is the moment to reassess. If you own rentals in Austin, Phoenix, Denver, or Tampa, understand your property valuations are being revised downward by the same lenders who finance them. Fannie Mae just told you so in their own filing. Bookmark this video. Come back in 6 months and check every single number we just showed you. That's how confident we are in this data. Subscribe and hit the notification bell so the next video lands in your feed the moment it drops. And watch this one next. We'll see you next time.